Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at EON Resources.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community starting as low as $9 per month. If you're trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So, to kick things off today, what happens when a 60-year-old global oil cartel just suddenly fractures?
It alters pretty much everything, right? Permanently changing the price of energy worldwide.
Exactly. And today we're looking at one specific company that's uniquely positioned to profit from all this fallout. All right, let's move into the wealth building context.
Yeah, to really figure out why this specific stock is drawing so much institutional attention right now, you have to zoom out first. You need to look at the massive structural realignment that just hit the entire energy sector.
Because it's fundamentally changing global power dynamics.
That's right.
And commodity pricing as a whole.
Right. So on May 1st, 2026, the UAE officially exited OPEC.
Which is just, we're talking about the end of 6 decades of cartel discipline.
60 years. 60 years of coordinated supply management just vanished overnight. And because of that historic fracture, Brent crude is now operating in this highly restricted risk premium regime.
And we're seeing it trade tightly between, what, $100 and $110 a barrel?
Exactly. It's a completely new world for energy investors. And EON Resources seems perfectly positioned for some really extraordinary long-term portfolio growth here.
Yeah.
It really is, like a generational wealth-building setup. When a structural pillar of the global energy market loses its third-largest producer, the ripple effects, they alter everything.
Because for 60 years, that cartel has artificially managed supply to smooth out volatility.
Right. If prices dip too low, they cut production. If they spike too high, they open the taps. But with the UAE walking away, that safety net is entirely gone.
So the market is suddenly pricing in this permanent risk premium.
Yes. And for anyone listening who might not, use that term daily, a risk premium essentially means buyers are paying extra for the fear of future scarcity. So that $100 to $110 range for Brent crude, it isn't just a momentary spike. It represents a new baseline reality of supply insecurity.
Right.
And for companies positioned correctly, this is the exact kind of macro catalyst that creates sustained multi-year value.
Okay, I hear the enthusiasm, but let me push back on this a bit with a very specific analytical question, if I can.
Sure.
We see geopolitical shocks happen all the time in the energy markets, right? Is this UAE exit really a structural shift, or is it just, a temporary pothole in the global supply chain?
Yeah.
Have we actually paved a completely new, permanently expensive highway for crude oil, or is the market just overreacting to a headline? Because banking a long-term wealth strategy on a temporary price spike is exactly how portfolios get wrecked.
No, that is exactly the right question to ask. And the answer lies in the actual mechanics of the exit itself. This wasn't just a temporary quota dispute.
Right. It wasn't a tantrum.
Exactly. It wasn't a disagreement over a single quarter's production targets.
Yeah.
It was a formal structural departure. The cartel's credibility is fundamentally damaged, and you just cannot unring that bell. The market is realizing that the era of coordinated, reliable global supply management is over. So looking at your analogy, this isn't a pothole. They have fundamentally altered the toll road. The risk premium we're seeing is the market pricing and the mathematical reality that future supply disruptions won't be easily smoothed over by a quick phone call between oil ministers. That creates a permanently expensive highway for Brent crude.
Okay, fair enough. Now let's look at the fundamentals because, macroeconomic theories are fascinating, but they ultimately have to show up on a company's balance sheet to actually matter to us as investors.
Absolutely.
How does this structural pricing shift actually translate to the microfinancial health of EON Resources?
Well, the company held its Q4 and full year 2025 earnings call recently, on April 28th.
Right, but we are still waiting on the granular audited 10K filing to drop, so we don't have every single line item yet.
True, but based on the preliminary numbers and this new $100 plus oil environment, the forward earnings trajectory is just dramatically skewed to the upside.
So we're looking at an expected windfall in free cash flow.
A massive windfall. Management, led by CEO Dante Caravaggio, is going to have a tremendous war chest to play with.
And they can use that cash to aggressively deleverage the balance sheet, boost their capital expenditures, or, issue substantial buybacks and dividends.
Exactly. And for anyone newer to analyzing these balance sheets, deleveraging simply means using that extra cash to pay down their existing debt.
Which is huge.
Right, because when a company pays down debt, they reduce their interest expense, which means even more cash flows directly to the bottom line in future quarters. It creates this compounding effect of financial health. But this is where their specific competitive moat becomes the central piece of the investment thesis. EON Resources operates domestic, low-cost upstream assets.
And that word domestic is the key to everything right now, isn't it?
It is. Because while the UAE's exit is creating a pricing floor, the ongoing crisis in the Strait of Hormuz is creating an immediate physical supply shock.
Right. Right now there are, 9.1 million barrels per day of Gulf production just sitting idle?
Literally, physically blocked by the crisis.
Wow.
And EON Resources is completely, 100% insulated from that logistical nightmare. They don't rely on the Strait of Hormuz to get their product to market.
So they get to sell their oil at these inflated global prices without facing any of the physical supply chain bottlenecks suffocating their international peers.
Exactly.
I have to admit, I'm feeling a bit of skepticism here, though. I mean, we are essentially flying blind before that full 10K filing is released.
I mean, not totally blind.
The earnings call gave us a preliminary look, sure, but without the audited cost structures, betting heavily on expanding margins feels incredibly risky.
I get that.
We know revenue will be up because the global price of oil is up, but inflation hits domestic producers too. Equipment costs, labor, pipeline transportation. Until you can see the granular data validating their expenses, assuming a free cash flow windfall feels a bit premature.
I understand the caution. I really do. But let me offer a different way to visualize this dynamic.
Okay.
Think of it like owning a local bakery when the global flour supply chain suddenly collapses.
Okay.
Because there is a worldwide shortage, the price of the bread you sell locally skyrockets. But you happen to have a long-term fixed-price contract with a wheat farmer right down the road.
Right.
So your local ingredient costs stay exactly the same. Your shelf prices are exploding higher, but your baseline costs are locked. You don't need to wait for your accountant's quarterly report to know your profit margins are expanding rapidly.
That's a good point.
That is EON Resources right now. Their lifting costs, which is the industry term for the actual expense required to pull a barrel of oil out of the ground, are relatively fixed and domestic.
But the price they sell that oil for is dictated by a global market that is currently panicking.
Exactly. That spread between their fixed domestic costs and the surging global price is pure free cash flow.
That brings us to the catalyst timeline. We have the macro setup, we have the fundamental mechanism for profit, but what are the actual events over the next 3 months that will force the broader market to wake up and recognize what we just discussed?
Because a stock won't move until the market is forced to reprice it.
Right. So in the short term, we have that impending 10K filing. That release is going to provide the hard, undeniable proof of their baseline cost structure and their exit rate production, effectively validating the bakery analogy you just laid out.
Which is critical.
And exit rate production, for context for everyone listening, just means the volume of oil they're producing at the exact end of the quarter, giving analysts a run rate to project into the next.
Right.
Then, looking to the medium term, we have the Q1 2026 earnings. That's going to be the inflection point, right?
The true inflection point.
It'll be the first full quarter that completely captures the new post-OPEC exit pricing reality. And, of course, in real time, we have the market constantly digesting the UAE's departure and every single daily headline regarding the ongoing blockage in the Strait of Hormuz.
You nailed it. I am heavily focused on that Q1 2026 earnings report as the ultimate structural catalyst. The 10K filing establishes the baseline, but the Q1 earnings report is the undeniable proof of concept. That is when the theoretical windfall we are discussing becomes cold, hard cash on the balance sheet.
And when Wall Street analysts see the actual realized price per barrel compared to their domestic lifting costs.
They will have absolutely no choice but to completely rewrite their financial models for the remainder of the year.
Right.
That forced institutional repricing is what drives the stock significantly higher. The market can ignore a narrative, but it cannot ignore expanding free cash flow.
See, I look at that timeline and I get nervous because you're treating the Strait of Hormuz like a scheduled static event.
Wow.
To me, Hormuz is the ultimate wildcard catalyst. It's not a scheduled earnings report you can just circle on a calendar.
No, that's fair.
You could have a single geopolitical headline drop on any given Tuesday at 2.0, and it could swing the stock wildly in either direction. If tensions ease unexpectedly, oil drops, and this whole windfall narrative takes a hit before Q1 earnings even arrive. It's an unpredictable variable that makes holding this stock through the next 3 months a highly volatile proposition.
It is volatile, absolutely. But that volatility is exactly why there's a premium to be captured here.
How so?
The uncertainty is what creates the opportunity for outsized returns. And that actually transitions perfectly into how the market is physically trading the stock right now.
Okay, now let's pivot to the chart. What are the technicals actually showing us? Because if this thesis is as strong as it sounds, we should be seeing it in the price action and the institutional flow.
Yes, we should.
Right now, the stock is currently digesting that April 28th earnings call. It is setting up what looks like a classic psychological breakout scenario.
Right.
But the fascinating part is that the stock is clearly not yet priced in the UAE and OPEC shock, largely because that news broke on the exact same day as their earnings call.
Which is wild timing. The broader market got completely confused and focused on the micro-financial details while entirely missing the macro shift.
However, underlying momentum is now shifting aggressively bullish. We are seeing signs that institutional capital is rotating heavily into North American exploration and production names to hedge against the Hormuz crisis. And EON Resources is sitting right there, primed to break to higher highs as that rotation accelerates.
The technical setup here is textbook. When you have a profound fundamental shift that isn't immediately reflected in the price action, it creates a coiled spring on the chart.
Right.
Retail investors are looking at the recent earnings reaction and thinking the stock is fairly valued. But behind the scenes, smart money is realizing the earnings numbers they just heard are already obsolete because oil jumped significantly the very same afternoon.
Yeah, that realization is what builds the pressure for that psychological breakout. But hold on, let's look at this practically. You are talking about institutional capital rotating heavily into North American names. But if we look at the chart, the stock hasn't actually broken out yet.
Sure.
It's still digesting in a sideways pattern. How can we confidently say institutions are aggressively rotating in if the price action hasn't decisively exploded through resistance?
Right.
If smart money was really backing up the truck, wouldn't the chart already reflect that high volume with a surging price?
That is the beauty of stealth accumulation. And it's a vital concept to understand when tracking smart money. Institutions do not buy the way retail traders buy.
Because they move too much volume.
Exactly. If a major hedge fund needs to acquire 2 million shares, they don't just hit the buy button all at once on the open market. Doing that would send the price rocketing upward, ruining their own average entry price.
Ah, so they hide it.
Right. Instead, they buy in dark pools, which are private exchanges designed to keep large trades hidden from the public tape until they are completed. They buy incrementally on down days. And they use algorithmic execution to slice their large order into thousands of tiny invisible chunks, absorbing shares quietly while the stock trades sideways in a consolidation range.
Wow. So they actively want the chart to look boring while they load up.
They seek out domestic safe havens during geopolitical crises well before the retail crowd catches on. So a sideways chart with a subtle shift in underlying momentum is exactly what stealth institutional accumulation looks like before the actual breakout happens.
So what does market sentiment look like? Because if the chart is secretly bullish and the fundamentals are strong, you would naturally expect the quantitative data to reflect that optimism.
But it doesn't. And this is where the real mispricing opportunity lives for anyone paying attention.
Right now, the quantitative sentiment score, based purely on that April 28th earnings call, is completely neutral. It is literally sitting at a score of 0.
Which is crazy.
The neutral market mood is completely detached from the seismic shift happening in global oil. Because of this disconnect, analyst upgrades are highly probable very soon as they scramble to update their 2026 models with $100 plus Brent forecasts.
Definitely.
Plus, there is a very interesting rumor floating around that EON Resources is a prime speculative acquisition target.
Oh, yes. Large integrated majors are reportedly desperate to secure non-Gulf cash-generative crude assets, and EON fits that bill perfectly.
The acquisition rumor makes total strategic sense. I mean, if you are a global super major with heavy exposure to the Middle East, you are terrified right now.
You're in panic mode.
Right. You need domestic, stable production immediately to balance your portfolio risk, and buying a company like EON is the fastest way to get it.
Absolutely. But let's look closely at that sentiment score of 0, because that is the true alpha generation opportunity for you as an investor. Quantitative sentiment algorithms essentially scrape text. They read the earnings call transcript, they count the positive and negative words used by the executives, and they spit out a mathematical score.
Right, but a neutral score usually means the market is just bored. It means management didn't say anything inspiring, the forward guidance was flat, and investors are looking elsewhere for growth.
Usually, yes.
A 0 score usually tells me to stay away because there is no institutional excitement. Why should we trust this bullish thesis when the hard data says the market simply does not care?
Because the algorithm lacks real-world context. Let's think about how this technology actually works.
Okay.
The algorithm scraped the earnings call transcript on April 28th. It analyzed the CEO's specific words about their past Q4 performance. What the algorithm did not do, because it is not programmed to, is look at the broader news cycle that happened on the exact same day.
The UAE exiting OPEC.
Exactly. It completely changed the valuation model of the company, but because it wasn't a topic discussed in the historical earnings transcript, the sentiment score remained 0.
So the quantitative tool missed the macro event entirely.
Entirely. That is why the stock is fundamentally mispriced. The algorithms are backward-looking, analyzing what happened yesterday. The smart money is forward-looking, analyzing what happens tomorrow.
Now let's talk about the risks. We always have to look at the bear case to keep ourselves grounded. What could completely derail this bullish momentum?
Yeah, let's get into it.
First, we have the obvious one, Hormuz de-escalation. If the Strait suddenly reopens, that 9.1 million barrels per day of idled Gulf production floods back into the global market.
Right.
If that happens, the profound Brent risk premium we've been talking about deflates rapidly. Second, there's the UAE production ramp.
Yeah, that's a big one.
The UAE didn't leave OPEC just to sit on their hands. Their stated goal is to hit 5 million barrels per day by 2027, outside of any quotas. That is a substantial amount of new supply that could severely depress global prices.
True, but the mitigations here are important. Even if Hormuz normalizes tomorrow, OPEC's credibility is permanently damaged, which theoretically establishes a higher structural price floor anyway. Furthermore, the UAE currently lacks the logistical infrastructure to transport that extra oil immediately. So even in a bearish scenario, EON Resources still has a multi-quarter runway of outsized cash flow before that new supply hits the market.
Exactly. The bear case relies heavily on the immediate, flawless execution of supply returning to the market, which in the physical commodity world is almost impossible.
Right, you cannot just teleport millions of barrels of oil into the global pipeline network overnight, even if the political situation resolves perfectly. It takes time to restart idled infrastructure.
Let me play devil's advocate heavily here, though.
Bring it on.
Let's say peace suddenly breaks out in the Middle East tomorrow. The treaties are signed, the ships start moving freely through the Strait of Hormuz, and the immediate panic just evaporates.
Okay.
Does this entire investment thesis collapse? Because if the only thing holding Brent crude above $100 is fear, right, and that fear vanishes, EON Resources is suddenly selling oil at $75 a barrel again, and all those free cash flow models go completely out the window.
It doesn't collapse, and here's exactly why. The permanent damage to OPEC's credibility.
You really think that's enough to hold it up?
I do. You have to separate the short-term geopolitical fear from the long-term structural reality. Yes, if Hormuz opens tomorrow, the price will pull back from its absolute peak. You might see it drop from $110 down to $90. But it is not going back to $70. The UAE's exit proved that the cartel can no longer guarantee supply discipline. The broader market has learned a very hard lesson about supply fragility.
So that psychological scarring creates a permanent floor under the price of oil.
The trust is gone. So even in your absolute best-case peace scenario, EON Resources is still operating in an environment where their realized price per barrel is significantly higher than their historical average.
Keeping those domestic margins wide and that cash flow incredibly strong.
Exactly.
So with everything on the table, what's the final verdict? When we weigh the fundamental windfall of $100 plus oil, the technical setup of stealth accumulation, the mispriced sentiment algorithms, and the very real geopolitical risks, we arrive at a bullish score of 8 out of 10.
Yep, 8 out of 10.
The investment view here is a medium-term hold, looking at a 3 to 6-month horizon. EON Resources is a compelling buy specifically because it is mispriced based on a neutral earnings call that completely ignored the structural shift in global crude.
Right.
As a domestic producer, it is perfectly positioned to convert global macro chaos into a structural free cash flow windfall, entirely insulated from the physical supply chain bottlenecks overseas.
Hold on.
If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
As you close out your charts today, just ask yourself this. When the dust settles and the algorithms finally catch up to reality, will you be the one holding the bakery when the flour runs out everywhere else? Keep a close eye on that upcoming 10K filing.